We are taxed when we buy things, when we sell things, when we gift things, for being born, for dying, for traveling. And there is one crazy hidden tax you may have heard of, but most of you don't even realize the destruction it's causing on your long-term financial abundance. Welcome to The Download. This is a show about living abundantly as we align with God and His purposes for each of us. I'm Judson Morgan, entrepreneur, award-winning filmmaker, grandson of a preacher, son of a Christian economist. My companies have generated over $100 million in revenue, and I am on the abundance journey with you. Our first series here is on financial abundance, because I believe that unlocking financial abundance is a key for many of us to truly living an abundant life in every way. In today's world, if we are trapped financially, if we're trapped in financial scarcity, we often get stuck in scarcity in other areas of our lives. So that's why we're starting with financial abundance. Let's get started. What if I told you that 51% of what you earn in your lifetime will go to paying taxes? That's like working half of your life for the government. Say what? I mean, that is nuts. You with me? Most of you hate paying all that tax, but you think you have to. As Ben Franklin so famously said, there is nothing certain except death and taxes, right? And even Jesus said, pay to Caesar what is Caesar's. So, is that it? Taxes are just a necessary Christian civil duty? Whatever the government or your CPA tells you to pay, you just hand it over? What if I told you that there are 75,000 pages of tax code and 74,000 of those, about 74,000 of those, were written to help you pay less tax? Yeah, you heard me right. Most of you think it's the opposite. 74,000 pages on ways the government is going to take your money. Nope. The IRS has written most of the tax code to help you keep more of the money that you make, save, invest, and pass on. My objective with this podcast today is to first give you a framework around how to think about tax from an historical and ethical/biblical perspective. Because as I often say, your thoughts create your reality. If you think paying 51% tax throughout your life is inevitable or even biblical, if that's what you're thinking, then you have no reason to discover concepts and ways of paying less. So you won't. The first part of this podcast will be to unlock the subconscious system inside of you to see the value and rationale behind paying less tax. And my second objective with this podcast is to give you tangible strategies to pay the most appropriate amount of tax for your life, your finances, your family, and your calling. For many of you, this means paying way less tax than you do now. Doesn't that sound good? I can hear some of you saying, but I don't pay 51% tax. I'm in the 20% tax bracket. I hear you. Many of you are in a lower tax bracket, but that's just income tax. Do you even realize that there are dozens of other taxes you're paying, some of them on a daily basis? And there is one crazy hidden tax you may have heard of, but most of you don't even realize the destruction it's causing on your long-term financial abundance. I think it's worth a few seconds to remind you of some of the taxes you're paying. We are taxed when we buy things, when we sell things, when we gift things. We are taxed for things we own, where we live, for importing something, for exporting something, for being born, for dying, for traveling, for buying gas, for making money. There's extra tax for earning more money. The more you earn, the higher percentage you pay. You are taxed for education, for inheriting money, for smoking or drinking, starting a business, for paying employees, for earning money from a job, for owning property or land, for selling property or land, and the list goes on. But the worst tax of all, the kicker, the hidden tax, the secret tax on everything at all times, do you know what it is? Spell it with me. inflation. Inflation is nasty. It works its dark magic in two ways. The government prints money, and your dollar has less and less value over time. For example, in 1913, $1 could buy 30 Hershey bars. Now it can buy half a Hershey bar. The dollar has lost 96% of its purchasing power in the last 100 years. I mean, we've seen this just in the last 6 months. Go to the grocery store 6 months ago. It's a completely different thing than going to the grocery store now. Not good. And it's like a frog slowly boiling in water. It doesn't jump out, because it's heating up so slowly that it doesn't even notice it's being cooked. And secondly, when your dollar has less value, the government quietly benefits because the debt that the government owes becomes cheaper to repay in weaker dollars. Said another way, the debt amount stays the same, but the dollars the government uses to pay it back cost much less. As Thomas Sowell puts it, inflation is a way to take people's wealth from them without having to openly raise taxes. Inflation is the most universal tax of all. It's a sneaky, hidden tax that robs you while pretending to leave your paycheck untouched. It's the number one revenue generator for the government. Our founding fathers would not be pleased. If you think back to your U.S. history class, the American Revolution was sparked in large part by outrage over taxes, right? You remember? Specifically, taxation without representation. The colonists broke free from British rule because they believed the taxes imposed on them by a distant government without their input or consent were fundamentally unfair. When our founding fathers established the tax system for the United States, it was funded primarily by taxing imports, not taxing its citizens. There was no income tax. Income tax only came later during the Civil War to cover wartime expenses. Since then, we've moved further down a path where higher earners are taxed at increasingly higher rates. This is called a progressive tax structure. Some might argue that this system aligns more with Marxist principles than with the vision of our founders. But it's safe to say this isn't what they had in mind when they designed a system rooted in limited government and individual liberty. Okay, you may be thinking, this guy definitely had a father who was an economist. But what about the pay unto Caesar part from Jesus' teaching? Let's take a quick look at what the Bible says about tax. Bottom line, yes, we should pay taxes. Jesus made that crystal clear when he said, give to Caesar what belongs to Caesar and give to God what belongs to God. And that's in Mark 12. He acknowledged that we have a responsibility to earthly authorities. But Jesus also reminded us that our ultimate allegiance is to God. Paul builds on this in Romans 13. Pay your taxes too, for these same reasons. For government workers need to be paid. Give to everyone what you owe them. Pay your taxes and government fees to those who collect them, and give respect and honor to those who are in authority. So Paul saw paying taxes as part of honoring the role of government, an institution that God allows to maintain order in society. But here's the tension. When we compare the biblical model of taxes to the modern system, there's a major disconnect. In the Bible, taxes were flat and fair. Take the half shekel tax in Exodus 30, for example. Everyone paid the same amount, whether they were rich or poor. It was simple and equitable. Today, though, we're in a system where the more you earn, the more you're taxed. And those who understand the IRS code can find ways of paying less, which often leads to higher tax rates for those who don't have the resources for better tax strategy. And it's commonly understood that most of us will end up paying 51% of all we earn during our lives to the government. This is not what we see in the Bible. Historians tend to agree that at the time of Jesus, Caesar would have been taxing the people at about 15% of their income, not 51%. So when Jesus said, pay to Caesar what is Caesar's, he's referring to a 15% tax. Here's the tension. How do we balance our biblical duty to pay taxes with God's calling to steward our resources wisely? God is the owner of all. We are the stewards, right? From the book of Proverbs, we read, good people leave an inheritance to their grandchildren. Stewardship means looking ahead, planning to the future, providing for the next generation, using our resources to further God's kingdom. Maybe you personally feel called to fund government efforts. That's your call. But I think many of you aren't paying all that tax because you feel good about it. It's not a choice that you're making, right? You just don't know it's possible to legally and ethically utilize all those funds in other ways. We must be intentional with our resources. These are the resources God has given us. And that's true for our time, our talents, and our treasure. We want to live abundantly. We want to perpetuate abundance in this world, right? We want wealth to grow, not get stuck in a system that isn't aligned with God's will. Much more could be said about the history of taxes in our country, in the world, and the biblical breakdown of tax back then, but I'll leave that to my dad. I think what I've said is a good enough framework to continue. I'm sure many of you just want to get to the actual tax saving strategies, and I'm excited to lay those out for you as well. But okay, will you allow me just one more minute to set this up for you before we dive into the strategies? If not, if you're just overall this mental framework, skip ahead and get to the strategies. But for those of you who want to get to the root of the whole tax issue, I want you to think of your financial life as a ship. You've built this ship with your work, which leads to income, which leads to savings, which leads to investments and all of your plans for an abundant financial future. This ship is supposed to take you across the vast ocean of your life. The world is out there waiting for you, full of promise. The ocean is vast and exciting. You've got your family on board. Your kids are safe and sound on this beautiful ship. Tropical paradises await. New horizons and incredible adventures. But this ocean is also full of challenges. There are storms and waves and rough waters. And don't forget, you have to stay afloat. Now imagine this. Your ship, it looks incredible. I mean, it's well set up. The deck is polished. The sails are set. And it's packed with everything you need for your journey. You even have a crew on board. Tools and strategies to make the ship stronger as you go so the ship can increase its load. But there's one big problem. The waterproof hull is compromised. 51% of it is leaking, and you don't even know it. You set out on your life adventure, and you don't even realize that water is seeping in from day one, dragging you down. You're up on the deck. You're killing it. You're bringing in revenue. You're making money. You're growing. You have strategies to multiply what you're earning, but the more you bring in, the worse the leaks get. And you can't figure out why you're slowing down. You don't even know why you're sinking. Without noticing the leaks, going back to shore and fixing them, you're not going to make it where you want to go. Or worse, you're going to sink and your family with you. Or you spend your life trying to earn enough to keep you afloat without ever knowing why you're not getting anywhere. But no matter how hard you work up on that deck, there's nothing you can do to accomplish the abundant life you want without fixing the leaks. Let me make this super practical for you. Those of you who like facts and figures, buckle up. Let's do some quick math on someone who makes $100,000 per year. Let's say the objective is to save, invest the surplus, and build wealth over a 20-year period. So you're making $100,000 and we're talking about 20 years. Let's assume a 10% yearly return on your investments, okay? The only variable we're going to change is the total effective taxes paid. So person one pays a 50% effective tax. Effective tax is just the total tax you pay in your life. And person two pays 20%. So we've got 50% and 20%. That's a 30% decrease in taxes on a yearly basis. That's the only difference between this example. Person one didn't earn any more money than person two. Person one didn't work any harder. Person one didn't have a better job or business. The only difference is the taxes paid over 20 years. Okay, so person one, this is 50% tax person, ends up with $2.8 million in savings after 20 years. Pretty good, right? Take the savings from $100,000 salary after life expenses and taxes and invest it at 10% and you end up with $2.8 million. Not bad. Now, what if we did the exact same thing and just changed the tax rate to 20%? Person two ends up with $5.15 million, almost double. Person two did nothing different except they had better tax planning and tax strategy to get them to a 20% tax rate. That's it. Do you get that? The reason we focus so much on tax is that with all the other things being equal, you'll end up nearly doubling your net worth. You don't have to work any harder. You don't have to have a better business, have a better job. So it sounds to me like the 20% activity that gives you 80% of the results is fixing the leaky ship. Side note, our next episode will be on other leaks. Tax is the first big leak, but there are other leaks that we're going to talk about in the next episode. Quick break to tell you about our sponsor, Butter. Butter is my commercial video production company specializing in story-driven 15 and 30-second commercials for connected TV, Facebook ads, YouTube, pre-roll, all that sort of stuff. If you're looking to up your ad game without blowing up your marketing spend, check out www.butter.la to learn more. Also, just a quick disclaimer. Nothing in this video or podcast is financial, legal, or tax advice. It's for education and entertainment purposes only. Always do your own research. Consult a professional before making any financial or legal decisions. Back to the show. If you skipped ahead, this is where you skip to. You've made it. You've made it. We're here. We're going to start talking about some tax strategies. Let's dig into how we are going to save taxes in 2025 and beyond. Many of these strategies work all over the world, but I'm in the US, so I'll be talking about our tax system specifically. Remember, What is the tax code for? It is a way for the government to encourage certain activities. Let's look at the activities the government says will lower our tax burden. The tax code is a roadmap that if you follow will lower your taxes. In the words of tax expert Tom Wheelwright, if you want to change your tax, you need to change your facts. So, what are the things the government will pay you by lowering your taxes to do? Start businesses, and that's because businesses solve world problems, feed people, clothe people, etc., and the government wants you to do that. Buy and develop real estate. The government wants you to help house all of its citizens, so it incentivizes that. The government wants you to give to charity. This is the government's way of helping you help those in need. The government wants you to put money into your retirement accounts because the government wants us to be able to fund our own lives as we age rather than it falling on the state. The government wants us to educate ourselves, so there's tax incentives to educate ourselves. The government wants us to adopt children, so there's tax write-offs for adoption. The government wants us to save for healthcare, similar to retirement. We can take care of ourselves. So given those high-level instructions from the government, let's fix our leaky ship. What leaks can you plug up this year? Remember, tax strategy and tax planning take some effort and diligence. Much of this needs to be done on a yearly basis at least, and many of these strategies take ongoing maintenance. This is why I spend so much time in this podcast giving you the framework. If you don't realize how much your taxes are hurting your financial future, if you don't feel that pain, you won't be motivated to make the changes. You don't have to be rich to save on taxes. I'll show you strategies now that anyone can start using right away. And then we'll move into more complex strategies and long-term tax planning, okay? Number one strategy is get a better CPA. This is the secret that no one tells you. Most CPAs have zero interest in saving you tax. They think their job is to make sure you don't get audited. Does that make sense? They don't even think their job is saving tax. They think it's saving you from audit. They just want you to pay your taxes, file correctly, and not get audited. They don't even try to save. I had to learn this lesson the hard way by paying way too much tax. Tax strategy is different than the busy work of filing your taxes. Most of the time, there is nothing your CPA can do by the time they're working with you to file your taxes. One of the ways to know if you need to change CPAs right away is if you don't have multiple tax planning meetings with them per year. Then you know. At least one meeting in October or November to plan for the year end. But the reality is, the way the industry works, it's really on you to learn these strategies and implement them yourself and give your CPA everything they need to file your taxes with all the deductions that you have laid out. There are good CPAs. There are CPAs who think about saving tax, but the majority don't. And now, what if you don't use a CPA? What if you're filing your taxes yourself? First, itemize your deductions, okay? The standard deduction is your enemy. Once you itemize, you can add many of the deductions we will discuss through the rest of this show. Number two, change how you get paid. Are you paid as a W-2? Your best plan would be to work with your employer to get paid as a 1099 rather than a W-2. As a W-2, you are paid as an employee. As a 1099, you are an independent contractor. This is the famous rich dad, poor dad concept from Robert Kiyosaki. He talks about tax in 4 quadrants from highest to lowest. 1 is W-2, that's the highest tax quadrant. 2 is self-employed, that's 1099. 3 is business owner, and 4 investor. Many of you would be surprised to know that you can make this work inside of modern companies. They'll be open to moving you from a W-2 to a 1099. What are the benefits of going 1099? You unlock all these deductions. The IRS calls them ordinary and necessary expenses for doing the work that you do. These things could be a percentage of your phone bill, your rent, utilities if you work at home, your car expenses, office expenses, marketing expenses. Many of you could unlock up to 30% savings on your tax just from moving to a 1099. And by the way, it's better for your employer in many cases as well. If you're a W-2, they pay more in Social Security and Medicare. As with all these strategies, the details really matter. So remember, these things take diligence and care, but the growth is exponential over your lifetime. Number 3, what if you have to stay at a W-2? And many of you do, and you should. You have great jobs, and you should stay there. Are you out of luck? No. This is where your hobby or your side hustle can unlock the tax code for you. Formalize your side hustle by opening an LLC, but you can even use your independent contractor status to unlock these savings. The key here is that you are working toward building an income from this side hustle. When you do that, you move into quadrant 2 or 3, and you can unlock all the deductions that we've mentioned already. Your computer, your car, your office, utilities, etc. These expenses move from the category of costs to deductions against your income. Another idea, move. Not always easy to do, but very easy to understand. If you move to Wyoming from California, for example, you would decrease your taxes by 6% every year forever. Or you could move to Puerto Rico and pay 0% tax on income generated there, 0% on capital gains, etc. Maybe you've seen this trend, a lot of entrepreneurs moving to Puerto Rico. That's why. There are obvious challenges to moving. For example, I have stayed in California, even though the taxes here are insane. But if you stay in a high tax state, all the more reason to become a tax ninja. Another idea is an HSA account. Open and fund a health savings account. When funds go in, it's a deduction. They grow tax-free and can be used tax-free for health expenses. Another idea is funding a retirement account. If your employer has a 401k match, fund that account for sure. It's deductible when you fund it, but taxes are paid on the growth when you take it out. A Roth IRA works the opposite. Money is not tax deductible when you put it in, so you don't get a write-off by putting $5,000 into a Roth, but the growth is tax-free. So when you take it out, you get the tax savings then. We would want to use that for funds that we believe have major growth potential, like a Bitcoin ETF, for example, or stock in a startup. The Roth can be a simple long-term tax strategy, but it also can be part of a much more advanced strategy for highly appreciating assets. Lots of details need to be considered. For example, it has funding limits and there's an income threshold you have to stay under in order to fund it. But IRA rollovers, meaning turning a regular IRA into a Roth, is a common strategy as well. As a side note, I have started a Roth for 2 of my children. I employed them through my businesses, and then I put that money into a Roth, and then I bought highly appreciating assets inside of that Roth to build tax-free wealth for them for the future. That's an idea. Another idea is to start and fund a 529 plan for your kids. Essentially, you get a deduction for funds you put into a 529, which you can then use tax-free for your kids' education. I don't have one of these, but many of my friends use this strategy. It's relatively easy, and if you have kids or plan to, you will have lots of education expenses. I don't use all of these strategies because they tie up funds. I try to balance my tax strategy for the most advantages while also keeping liquid funds for investment opportunities. This is more advanced and long-term planning, but a 529 plan will be good for some of you. Okay, let's move to the next tier of strategies. These are still totally attainable for you. They just take a bit more structure. The big idea is to move tax from you personally to a business, similar to what we discussed with the 1099. We can be taxed as an independent contractor rather than a person. The next step down that path is to be taxed as a business, as an LLC with an S-Corp election, or an actual S-Corp, or a C-Corp. All of my companies are S-Corps, except the LLCs that hold my rental properties. When you have a corporate structure, when you are taxed primarily as a business, your options open up considerably in terms of tax savings. This is why my first tax strategy was change how you get paid. Businesses pay lots of tax, but they also have most of the deductions. And your business can be your side hustle, or it can be your work inside of another corporation. Think about it. Doesn't the company you work for hire other companies all the time to do work for them? My video agency, Butter, who sponsors this podcast, thank you, Butter, is hired by other corporations to create marketing videos or run their YouTube strategy. And Butter's paid directly, not me, right? So I own the company, but Butter is paid. So Butter doesn't pay taxes on that money until after all of its expenses. So for example, Amazon was famous for showing no profit, right? You remember that? So Amazon paid no tax since it was reinvesting all of its revenue into growth. This is how business works. And the IRS knows and likes it. The IRS wants businesses to grow and expects them to not show profit at times. Businesses are taxed on the profit, not the revenue. Is this making sense? So if you can move what you used to call salary into the category of revenue, you're on the road to tax deduction heaven. Most of these deductions are exactly what you would expect. Almost every necessary expense to run the business is taken out of the revenue and therefore is not taxable. In the case of a side hustle business, this could be your home office, like we've said, office supplies, utilities, etc. Is that making sense? So once you have a business structure in place, there's a bunch of other deductions that you can grab. And I'm going to go through these, not in too much detail, but just sort of list them out for you. One's called Section 179. This is the 6,000-pound truck deduction. You can hire your kids, so you can move up to $13,000 from your tax bracket to theirs, which is zero. You can hire your retired parents, doing the same thing, moving tax from a high tax bracket to a low tax bracket. You can start a SEP IRA and get a tax deduction. You can do something what's called an Augusta rule. 14 days a year, you can rent your house out to your business. You can take travel expenses. You can take R&D credits. You can take professional development expenses. That's like courses and learning and stuff like that. You can deduct business gifts. You can deduct charitable donations of gear, inventory. You can deduct office pets. You can deduct business meals. Any expense that is ordinary and necessary for your business can be deducted. And a business doesn't even need to have any revenue. I mean, that's the crazy thing, just the genuine intent to make profit. So understanding the details of what the IRS is looking for, making sure your facts line up with the code can save you so much tax. So that's the biggie. Let's finish with a few bonus strategies, and then we'll look at what the ultra rich are doing just for fun. Charity. Do you give to your church? Make sure you add this to your tax return. Do you donate old clothing? Create a receipt. Deduct the value of the clothing. Do you take capital losses? So let's say you have stocks and they went down. Are you harvesting those losses? If you have some stock that took a loss, you sell that stock and the losses are deductible. This would be part of your year-end planning. You know, the year-end planning that you're not doing with your CPA. Take advantage of tax credits. Tax credits are different than tax write-offs. Most people don't understand the difference. For example, buying an EV, residential clean energy credit, child tax credit, earned income tax credit, American Opportunity Tax Credit, lifetime learning credit, adoption tax credit, energy efficient home improvement credit, savers credit, premium tax credit. Are you getting the picture? Another bonus idea is don't give the government a loan. If you're a W-2, you should not be getting a refund. This means that you gave the government an interest-free loan. Now let's talk about a few more advanced strategies. For example, how did Trump not pay any taxes? Well, I mean, he paid a ton of taxes, right? Just not income tax. His secret is the most obvious one of all, real estate. There's a reason most ultra wealthy own real estate. It's one of the most tax advantaged assets in history. Another idea that the ultra wealthy use is something called QSBS, qualified small business stock. It lets you avoid paying tax on up to $10 million or 10 times what you invested, whichever is greater, when you sell your company, essentially, as long as you held it for at least 5 years and meet some other rules. Another real estate strategy is to become a real estate professional. If you're a real estate professional, you can use rental property losses like depreciation to lower your taxes on other income. Even if you're making money overall, you can take deductions by owning real estate. So let's say I make a bunch of money as a W-2, or I make a bunch of money selling a company. If I'm a real estate professional, I can take the depreciation off of a rental house and lower the tax burden that I had elsewhere. Another strategy the ultra wealthy use is trusts. Wealthy people use trusts to shift assets out of their taxable estates, reduce income taxes, and control how wealth is distributed, often leveraging strategies like grantor trusts or charitable trusts for tax benefits. And they also borrow against their assets instead of taking income. Elon Musk, for example, did this. He borrowed against the value of his Tesla stock rather than selling it, which would incur tax, right? If he sells it, then he has to pay the tax on it. If he keeps it and borrows against it, there's no tax there. Another strategy the ultra wealthy use is whole life insurance. People use overfunded whole life insurance policies to save on taxes by building tax-deferred cash value, accessing it through tax-free loans or withdrawals, and passing it to the heirs as tax-free death benefit, effectively creating a tax-advantaged savings and legacy tool. I'm doing this. A HELOC is another idea, maybe one you've heard of. It's the same concept as borrowing against the value of your home rather than selling it and paying the tax, right? So you're borrowing against the value and you have that cash tax-free. So that was a mouthful. That was a lot of tax strategies. And in some ways, I just wanted you to know that there are 74,000 pages of tax ideas ways for you to save, and I just wanted to list out a bunch of them. One last idea is I want to make sure that you build a team. The ultra wealthy use what is called a family office. It's a team of tax and wealth strategists that help get their financial house in order. In the beginning, we need to do a lot of this stuff ourselves. There are tons of free resources on the web and on podcasts and YouTube like this show. And if you're in a spot where you have more time than money, the free content can get you pretty far. You just need to do the work of finding it. The next step would be joining a paid group or hiring a tax consultant or advisor for tax strategies specific to you. In Proverbs 15:22, it says, "Plans fail for lack of counsel, but with many advisors, they succeed." All right, I know this was a lot of information. Whew. Maybe you've heard some of these before, but I'm sure to many of you, a lot of this is new. It's overwhelming. But hear me out. I just want you to take one step. I want you to take the next step. Jesus says, don't worry about tomorrow. Worrying gets you nowhere. Worry is not the path to the abundant life. In my life, the way that I release worry is through alignment with God. Listen first. Remember our framework from the first episode. Sacrifice. In this case, maybe that sacrifice is listening to all these tax strategies. Maybe the sacrifice is not watching one football game this weekend. Number 2, align with God. Spend time with Him. Lay your finances before Him. Number 3, ask the Holy Spirit to guide you toward the next step for you. Number 4, take massive action. And number 5, believe. Trust that it will lead to abundance. Taxes don't have to be the thing that holds you back from building the abundant life that God has for you. I don't want taxes to be the thing that holds you back. I don't want you to have that leaky boat. I don't want you to feel that, like, why aren't I getting anywhere? Many of you are feeling that. And maybe today you're realizing that it's taxes. Oh my goodness, I can't get anywhere because my boat is leaky. So here's the challenge. Take just one thing that you've learned today. Start putting it into action. Whether it's getting a better CPA, itemizing your deductions, starting a side hustle, or learning how to move your tax burden from personal to business, take the first step. I am on this journey. I also need to take the next step for me. I need to plug some of my leaky taxes. I'm excited to hear how these strategies help you unlock financial freedom and live out your calling. God bless you, and that's the pod.